In my previous dossier, I exposed the shadow network propping up the US debt market against China's massive structural liquidation. We traced the forensic evidence to proxies in London and hedge funds in the Cayman Islands, obscuring the true extent of the damage. But if you believed Beijing was the only major power heading for the exit, you were looking at the wrong map entirely. While the world fixated on China's noisy dumping, a quieter, more significant signal emerged from the global economy's swing state, India. For 30 years, India was the reliable, passive buyer, recycling its trade surpluses back into the safety of American government bonds. It was the boring bedrock of dollar hegemony in the global south, a predictable trade that everyone took for granted. But in late 2025, that trade broke, and the latest Treasury international capital data confirms a structural shift is underway. Wall Street is desperate to ignore this reality, as it complicates their simple narrative that China is the only economic adversary. Between October 2024 and October 2025, India aggressively slashed its holdings of U.S. Treasury securities by nearly 21%. The Reserve Bank of India liquidated approximately $50 billion of debt, collapsing their holdings from a peak down to $190 billion. This is not a seasonal fluctuation or a minor currency adjustment. It is the first sustained annual decline in 4 years. Crucially, this selling is happening in a market environment that defies traditional economic logic and demands our immediate attention. With U.S. Treasury yields hovering between 4 and roughly 5%, this should be an attractive risk-free return for a central bank. Historically, when yields are this high, foreign central banks accumulate bonds to lock in the guaranteed income they offer. India is doing the exact opposite, actively selling into the yield and walking away from a solid return in the world's reserve currency. When a central bank sells a high-yielding, liquid asset, they are making a profound statement about risk, not return. They are stating clearly that the yield is no longer high enough to compensate for the fundamental risk of holding the asset itself. This is a strategic divorce, and we must analyze the Reserve Bank of India's balance sheet to understand the intent behind it. Is India selling because they are broke, or because they desperately need the cash to defend a collapsing currency from crisis? The data says absolutely not. India's foreign exchange reserves are sitting near record highs, swimming in unprecedented liquidity. Since the selling is not driven by economic necessity, it is driven by a deliberate strategic choice, de-risking. The Reserve Bank of India is actively reducing exposure to the potential weaponization of the U.S. Treasury market. The governors in Mumbai watched closely in February 2022, witnessing a precedent that shattered global financial trust. They saw the United States and Europe unilaterally freeze $300 billion of Russia's sovereign assets overnight. For India, which maintains a fiercely independent foreign policy buying Russian oil and French weapons, this was a wake-up call. They realized that in a multipolar world, holding $240 billion of U.S. debt is not a safety net. It is a financial kill switch that can be activated by a single Treasury Department order in Washington. If India refuses to align with U.S. sanctions in a future conflict, those assets could be instantly frozen. Unlike China, which is dumping debt to fund a war chest, India is dumping debt to build absolute sovereignty. This shift deals a massive, underappreciated blow to the U.S. Treasury's long-standing funding model for its deficits. For decades, the assumption was that as developing nations like India grew richer, they would automatically buy more U.S. debt. That assumption is now dead. The natural bid from the emerging world has fundamentally reversed direction. If the fastest-growing major economy on Earth isn't buying our debt, a structural hole is opening in global demand. This makes the reliance on the hidden buyers and hedge fund proxies we discussed previously even more critical and dangerous. India is voting with its feet, and the proceeds from this $50 billion sale didn't just disappear into thin air. The capital transformed into the only asset with no counterparty risk, no political allegiance, and no digital kill switch. If India isn't holding U.S. treasuries, they are holding physical gold, but the location of that gold is the real story. To understand the magnitude of this shift, we must revisit the deep, traumatic history of India's relationship with its gold. In 1991, India faced a severe balance of payments crisis and was days away from defaulting on external debt. To secure an emergency loan, the government suffered the national humiliation of physically airlifting 67 tons of gold to London. For the next 30 years, that gold remained in London, kept there for convenience and integration with Western markets. It became financial gold, easy to trade, easy to lease, and deeply embedded in the liquidity of the London system. But in 2024, the Reserve Bank of India initiated a massive, covert logistical operation to reverse this history. They decided to bring the gold home, transforming a distant financial claim back into a physical sovereign reality. Recent disclosures from the World Gold Council confirm India repatriated 274 tons between March 2023 and September 2025. In the first half of fiscal year 2025 alone, they quietly airlifted 64 tons from the UK to domestic safety. This metal now sits in high-security vaults in Mumbai and Nagpur, fully removed from the jurisdiction of foreign powers. This represents one of the largest physical transfers of gold by a central bank since Germany's repatriation efforts a decade ago. As of late 2025, over 65% of India's gold reserves are now held physically within the sovereign borders of India. Why undergo the logistical nightmare and security risk of flying hundreds of tons of heavy metal across the globe? Because gold in the Bank of England is a financial asset, a ledger entry subject to UK law and regulation. It can be leased out, rehypothecated to multiple claimants, and crucially, it can be frozen by political decree. If the UK government, acting with the US, decides to sanction India, that gold becomes inaccessible digits on a screen. Gold in Mumbai is a sovereign asset, under the direct physical control of the Indian military and industrial security forces. It cannot be frozen, it cannot be sanctioned, and it cannot be leveraged by Western banks for their own liquidity. By moving the metal, India is surgically removing the counterparty risk of the West from its national balance sheet. They are effectively signaling, we do not trust the rules-based international order to protect our property rights anymore. While repatriating legacy gold, they are also aggressively buying new metal, pushing total reserves to approximately 880 tons. India was the second-largest net buyer of gold in the world last year, trailing only China's massive accumulation. The value of this gold hoard has crossed $100 billion, a fortress built to replace the paper debt they sold. This is a textbook collateral swap, exchanging an unsecured liability dependent on Washington's promises for secured collateral based on physics. A central bank does not undertake such a complex logistical operation if they believe the world is heading toward integration. They do it when they fear fragmentation. This repatriation signals that the era of trust is over and the era of possession has begun. India is the loudest signal because they are ostensibly a strategic partner of the West, not an adversary like China. When your partner starts withdrawing their savings from your bank to hide them in their own vault, the relationship has fundamentally changed. The timing of this unwind in late 2025 is not accidental. It is deeply connected to India's broader geopolitical calculation. The Reserve Bank of India has explicitly stated in reports that this diversification is driven by geopolitical risks and the need for insulation. In the diplomatic language of central banking, this is a shout. They are actively preparing their economy for a post-dollar world. India envisions itself as the Vishwaguru, the leader of the global south, positioning itself as a distinct third pole in a multipolar system. To play this role, they must trade with everyone, buying oil from Russia, investment from Saudi Arabia, and technology from Silicon Valley. To maintain this strategic autonomy, they cannot be held hostage by the payment rails of the US dollar system. Here is the mechanics of the trap they are avoiding: secondary sanctions that punish neutral nations for trading with America's enemies. If India holds $200 billion in treasuries while settling trade in dollars, they are vulnerable to immediate economic coercion. The U.S. Treasury could effectively shut down the Indian economy by blocking swift access or freezing assets with a single administrative order. By swapping treasuries for domestic gold, India becomes effectively sanction-proof, able to settle balance of payments deficits without American permission. Gold allows them to bypass the U.S. banking system entirely, serving as the ultimate neutral reserve asset in a fractured world. We are seeing this strategy operationalized through the internationalization of the rupee and the creation of parallel trade plumbing. The RBI has opened special Vostro accounts for over 20 countries, including Russia and Gulf nations, to settle trade in local currency. While volumes are currently small compared to the dollar tidal wave, the trend is undeniable. India is building a sovereign financial architecture. The $50 billion exit from U.S. Treasuries is simply the funding mechanism for this massive project of national independence. This structural shift means the natural bid for U.S. debt from emerging markets is actively dying. For decades, nations exported goods to America and recycled dollars into treasuries to keep currencies cheap. That model is breaking. India now invests in gold, domestic infrastructure, and its own digital payment stacks. If the developing world stops recycling trade surpluses, a massive pillar of support for U.S. deficits crumbles. This forces the U.S. system to rely on fragile hedge fund proxies and dangerous money printing. India anticipates this dilution and is exiting before the value of their reserves is utterly destroyed. They're engaging in a non-aligned hedge, betting that the future belongs to holders of hard assets. The conclusion is simple. Smart money is decentralizing, leaving the dollar network for independent fortresses of wealth. So how do you protect your wealth when central banks are rewriting the rules of the global game? Protocol Rule 1. Follow the central bank whales because they see the flow of funds first. When the RBI buys gold, they are buying insurance against system failure, and you must do the same. Protocol Rule 2. Diversify your currency exposure because the dollar's utility as a sole store of value is diminishing. Inflation will monetize the debt others refuse to buy, so own assets that printing presses cannot debase. Protocol Rule 3. Watch the repatriation signal. It is a lightning flash revealing the erosion of trust. If this trend accelerates, it will trigger a global bank run on physical metal that breaks the paper market. The global game of musical chairs has begun, and the biggest players are already removing the chairs. India unwound $50 billion not for profit, but for survival against Western volatility and weaponization. The hidden buyers masked this impact temporarily, but the fundamental message from the East is undeniably clear. They are leaving the building and taking their gold with them, signaling the end of the unipolar era. Do not be the last person holding the paper liabilities of a bankrupt empire. The protocol is active.